Hello guys, I hope you're having a good start to the week. I'm just going to show you a little entry model that I've been working on. It's more to do with not missing trades. And I haven't missed a single trade entry that I would have done in my previous entry model with this one. So I'm going to go through it. There's two sorts of examples as they are written out as an illustration in front of you. It's a 3-step plan, which I've written out so you can look at this and go back over it, or even screenshot it if you need to. So we'll go through the wick example and then the body example, and then I will show you a real life example using the wick from the 3rd of February, which was Friday. This was recorded on Monday on a London long, just pre NFP, which ended up hitting 2R. So to start with, this requires a liquidity sweep of some sort. So going back to the previous videos, we can either look at protected highs and lows, fail to close, or we can look at a couple of ICT concepts such as session low, session high, previous day high or low, previous week high or low. So it's more significant ones, significant highs and lows, which we require a sweep of. So on the wick example, we see a sweep of the low, or the low as in this example. Then we get a push back up to show that there are buyers in the market. We then see a push up, which is an impulsive candle. And then we use our Fibonacci tool as a Fibonacci retracement. And we look at the 0.75 as it is 3/4 of the candle. In this case, we want the candle body to close over the 75 fib level. This is because it shows a heavy push into the market and there are buyers in that market. We require this on the 5-minute candle. This is because it's more significant to have on the 5-minute than the 1-minute, because there's much more orders going into the market. And instead of having just a quick sweep and then a 1-minute candle being impulsive, it's not worth the risk, in my opinion. I think with the 5-minute candle, you then end up having a bit of a bigger stop loss. So that allows you to have much more clarity and you feel much more comfortable in a trade than having a 2-3 pip stop loss based off less, such as ICT or any other entry models that you use. So we can look at the right hand side. This is the body close example, because we know that sometimes markets want to take the lows, but we're not always going to get that initiation. So we allow people selling the breakout to get into the market. As you can see on the middle candle here, we do have the wick, we have some sort of buyers into the market, but then we have these sells. This now confirms that we're going to have people trying to sell the market, try to sell the breakout. They do always have sell stops on the lows and the highs, so they've got into a bit of profit. They're happy. They're thinking they're going to break out the market and everything's going to go well. However, when we see this next impulsive move up, then we know that we've allowed one candle to get the sellers into the market, allow the BFIs to accumulate in a smaller level than they have on the wick sort of entry. And it's got more people into the market who may have put sell stops a bit further below, or who have got stop losses on the low with a bigger stop covering the lows, which then creates a larger liquidity pool. So then again, we use our Fibonacci tool. So it's from the bottom of the candle, which could be the wick or the body. In this case, it is the body because we do not have a bottom wick. And then we put it to the top wick. We find that price has got a body close over the 75 Fibonacci level. And then we will take a market execution covering the low. So now I'm going to show an example of what happened on Friday in London session, so you can see for your eyes what happened in real time. So we've now gone over the illustration and you have been able to see and understand what I mean in a hypothetical situation. I'm just going to show you the trade that I took from Friday and break down the understanding of why I took this and including the candle formation entry. So we'll move from the left and we'll go to the right. There's very little steps to this, so it is very simple to follow and reiterate into your own trading. So here is the low of New York, which we marked out here in our pre-session analysis. As you can see, we did have a massive move down, filling FOMC on Thursday afternoon. Then we have a very ranging Asia session. It does push up and take the Asia high at London Open. And then when we have this push down, I see both sides being a sell rate. So I'll just mark this off so you can see what I mean by that. So as you can see, we have an impulse move down and it is a sell rate. We do get a candle break of Asia low. However, as our second confluence being New York low, we don't get a proper fill of it and we have a wick that goes through it. So then we look at the next candle. That is the impulse candle. So we look at our Fibonacci tool. We bring that out here. And we see that price closes above the 75 level. So as soon as that happens and as soon as this candle closes, we take a market execution. My stop loss is predetermined as it will cover the low by spreads, which is usually about 0.3 pips, and I will stick to that as a rule. So when this occurs, I do use a trade assistant, as I mentioned before, as it allows me to get quick entries with the correct risk management. I aren't affiliated to it in any way, but if you would want to get it, I will put a link in the description just to allow you to get your entries much better within risk, as it's just been a tool that I will never go without again, and I'll never take any trades away from it, as I then know exactly what I'm losing, exactly what my lot size is, and then I can see exactly what commissions I'm paying. However, we'll go back into this, and if you need it, just look at the description below. So when we've taken this entry here, we have had a little bit of a push up, feeling the imbalance to the left hand side. It feels it near to the point. We then push back down. So as we are counter trend, there is a high probability that we could continue. But when taking these two significant lows, for me, this is what I want to see, as liquidity is taken from Asia low, so people are trying to buy the breakout, and New York low, they're also trying to do the same. So now we have this move up. We do not have a break-even point, as the Asia high has been taken and the Asia low has been taken, and we are only targeting a fixed model of 2R, as we have a stop loss over 10 pips, because Euro USD doesn't have a massive pip range during the day, and especially before non-farm payroll news, price is going to be quite range bound. So we will take what we can out of the market, get paid, and we are done for the day. So hopefully that's been a good enough explanation for you on the entry model. I'll come back and do a few more examples at later dates, but hopefully you can take this, go and back test it and see it for yourself.